Firstly, just a little bit about DomaCom. We're an ASX listed company. When you read about startups, there's seed, there's angels, there's A's and B's and C's and D's. That's not the only way, okay? We decided to do effectively our B raising via an IPO, and that's the ultimate in crowdfunding, because that's what an IPO is. A crowd of, in our case, 500 individuals funded us. And why did we do it? It was expensive, but it gives me access to a truckload more investors, and there's automatic liquidity, which is good and bad. Obviously, our share price has gone, the roller coaster, as some of my investors said. Well, we're waiting for the up. But anyway, now we hold an AFSL and have done so for about 4 or 5 years. We operate a registered managed investment scheme. The word registered means that it's available for retail investors. It took us several years to get that authorisation, and the reason why is that we needed what's called ASIC reliefs. These are exemptions of the Corporations Act to make this work. And why did we do that? Because we're targeting, our initial focus is B2B. We're targeting a certain type of the financial advice market, and the advisors, frankly, can't invest or advise on private companies or unlisted public companies. So it's great to have, the crowdfunding platforms for, PTY LTDs and public companies, but they're going to be B2C, direct to consumers. The advice industry, I can't see anytime soon being able to include that, and the main reason for that is the PI insurance is going to be very difficult to us. It was difficult for us. Before advisors could use us, even once we got licensed 3 or 4 years ago, we needed to get research coverage. So we needed our structure, our fund, to be rated, and that took a while. So we started direct to financial planners only, but our experience last year with Kidman just changed our minds a little bit, because we had 5,500 people pledge 80 million towards the transaction. Clearly not enough. We got closer than people thought, but and what was interesting about that was the 5,500 people. Do you know how many wanted advice? None, 0. And that's where I think I'd listed another company which still listed Premium, and that was a very complex portfolio administration, equity derivatives, all that sort of stuff. And I found it was really hard selling that to direct consumers. Mistake I think I made with DomaCom to begin with is that property is very different. There's 100 people in a room, there's 100 opinions, north facing, south facing, 1 bedroom, 2 bedroom, and they're all right, okay? And it's much simpler to understand a property in terms of its capital growth and rent, and we all have beliefs. So that was a lesson I took out of last year. So we've been in the process of pivoting our, mostly technology, because we've built our technology for advisors, and now it's been pivoted, and hopefully in the next 3 or 4 weeks you'll see a brand new platform, which also enable people who aren't members of the fund to have a look at it, which we up until now haven't been able to do. So because we're a managed fund, we have a trustee, custodian. The custodian owns the assets on behalf of the investors. And so regardless of what crowdfunding platform you use, and to me, when I explain crowdfunding to people, it's really 2 things. There's a technology layer, which includes business process, where people come in to do due diligence, and they pledge towards a transaction target. The transaction target is to achieve an outcome: buy a property, buy a company, invest in a company, whatever it is. It's irrelevant, the same process. But when that transaction target is reached, the technology stops, because technology can't fractionalise an asset. You need a legal structure, and what a legal structure is: a PTY LTD, it's a limited public unlisted company, or in our case, it's a registered managed investment scheme. So we've chosen a different regulatory environment. So in the case of DomaCom, this crowdsourced equity fund legislation is irrelevant, because we don't raise money using that structure. We're raising money using a different structure. We've transacted 47 times, but with no debt. And so we've been struggling to find a lender. We've solved that problem, and hopefully in about 4 weeks, we'll be able to launch with being able to have debt. And why is that important is that from a property investment perspective, how many investors do you think buy properties with no debt? Hardly any, because it's not tax efficient. And so given our market is the advisor market, and the advisor market have this thing called FOFA, Future Financial Advice, they'll have best interest test, and in the best interest of their clients, they really can't invest in a structure that's not levered. The thing that's different in our case compared to most of the platforms that I've read about and the ones I've heard about today, we do not choose the asset, ever. The investors or their advisors choose the asset, they come to our platform and they'll list it. Now depending on what the asset is, if it's an advisor based, well, we'll let them list whatever, because what we do is that we allow you to start a crowdfunding campaign on anything, but we tell you there is a due diligence process that begins at a certain level. And in our case, it's for resi property, it's 30%. 30% we engage a conveyancing lawyer to check the title, contract of sale. 50% we do building inspections, pest inspections, valuations. We won't let it go through if we find something wrong, if the valuation is too far out of the transaction target. We've stopped 3 transactions already, all 3 on the Gold Coast for some reason. So anyway, so that's the difference. So summary is, crowdfunding is just really a modern form of syndication. It's been around for decades. The only thing that's changed is that you can now go to retail. Up until now, all the crowdfunding has been sophisticated investor crowdfunding, and that's really, it's been done by accountants for decades. You've got to be in the know, you're invited, it's all paper-based. Now it's all online, and there's a bit of, leverage going on in terms of, you don't have to know everyone. And with this new legislation, it can go retail. So it's going to be powerful. It's going to disintermediate the venture capital industry, the private equity industry. I've had a few people complaining already, so people that I know, about how the crowdfunding is a terrible thing because it's going to increase the price of the assets. What that means, in my view, is to more fairly price the assets, because a lot of these private equity venture capitalists, they just want to look after themselves and get the cheapest, the thing for the lowest possible price, screw the current investors. So, and crowdfunding democratises it and makes it a more industrial business process. And we started with crowdfunding as fractional property investing. We modified our financial services licence in February this year. We can now fractionalise anything. So at the moment it's just property. You'll see mortgages shortly, corporate bonds, and a few other things. Simply put, from the outside, because we're one fund, all you can do is put an application in to become a member of the fund. The money comes in and sits into our cash pool. For retail investors, because of our unique investor-directed structure, we've got what's called from an APRA, a retail look-through pricing. So ANZ is paying us 0.58% above the overnight rate for cash in that account, which we're passing on to the investors. Why? Because they have to do less reserves because we're not an institutional fund manager. And so once the money's being inside the fund with what's called a cooling off period, once that's finished, it's 14 days, they can look at publicly available campaigns, or if most of our 47 transactions have been through advisors, they'll see what they can see and then they can pledge towards that target. The next few weeks we're going to be launching what's called friends and family campaigns. So you can just log on, create a campaign. You want to buy that block in the corner with your friends and develop it or do whatever, or buy it as investment property for your son or daughter to live in. You can do that with DomaCom. We still will apply the arm's length independent due diligence process. So that's coming. So what we do is at the end of the campaign, if we are successful, we create a sub-fund on the fly. We also create what's called a supplementary product disclosure statement, which summarises all the due diligence material, and that's the formal offer for investors to invest in this sub-fund that will exist if we are successful in purchasing the property. So now, when I say property, our funds can now invest in anything, not just property. We can fractionalise any asset, including corporate bonds, including convertible notes, whatever we want. So, product disclosure statement, exactly, this is the rule for our world. They must read this product disclosure statement, which has all the features and risks associated with our platform and our investing. They open up an account, it's all online, AML, KYC, all online. They transfer the amount they wish to invest, they get an enhanced interest rate. They're actually getting a higher interest rate in our fund than they would if they invested their money in ANZ V2 because of the unique structure. They view the visible campaigns, they make a bid, and then they accept their supplementary product disclosure statement at the end. If everyone accepts it, it's now binding. We take the cash out of that cash pool, create a managed sub-fund, give them units in that sub-fund, we appoint a buyer's advocate, we acquire the asset. If the asset is acquired, it's under the ownership of Perpetual Corporate Trustee for DomaCom Fund DMC, blah, blah, blah. That DMC is what's called an APR code. So if you want to play in the financial planning world, you have to integrate to all their portfolio systems, their reporting systems, and so that's one of the things we've done as well. Now, the thing that's missing, I think in a lot of cases, investors, sure they want to know how much they want to make, but what they, particularly advisors, want to know is how do I get out? That's even before how much am I going to get out, how much I'm going to make. So the thing we had to address is liquidity. And so the first liquidity option is very straightforward. For most funds, they're 5 years. They can go 5 to 15 years, but Resi is 5. At the end of 5 years, we have a vote, and it must be 100% to renew. And that's an absolute liquidity guarantee. But then when we say this, is that, well, investors say, well, what if 99 want to renew and 1 doesn't? That's okay. Under the terms of our supplement, our PDS, the investors who want to renew can compulsory acquire the units of those who don't, using our secondary market. At the valuation, in 5 years' time, would have revalued the property just before the vote. So it's fair and equitable, absolute guaranteed liquidity event. That's the first. The second is, we do have maker market permissions in our financial services. We do have a secondary market, and it has been operating for several years. It's exactly like the shares. There's bid offer market depth. If I want to sell, if I bought something and then 3 months later I need it, we've already had it where people have had a life event and they've traded their interests out. That's another investor's bought. So basically, that's also unique. I'm not aware of any crowdfunding platform that has formal market maker permissions. And so we've implemented it exactly like you would ComSec or E-Trade. And because we're a registered scheme, our constitution basically says at any time investors can pull together and say, wind it up. In other words, we don't control the liquidity. If they decide this is a better time to sell that place in, I don't know, Balmain and buy a place over there, they have a vote, and if we get 75%, which is special resolution to wind it up, we'll wind it up. So effectively the control of liquidity is within the investor's hands. And that's important because people aren't going to put money in if they don't know how they're going to get out. So, now, our belief is property and then other fixed interest assets, corporate bonds and mortgages and everything else we're doing, belong in the normal advisor's remit. Up until now, when they do asset allocation, they'll say Australian equities, they'll say international, they'll say cash, fixed interest, and all this sort of stuff. But they exclude property. Why? Because property has not been within their regulatory domain. It is now, because that's what we've done. We've wrapped a property around in an MIS, which makes it within their remit. So they can now charge fees for it. And the thing is, you may think, oh, that's terrible. But if people don't charge fees, they won't give advice. And the key thing about advisors is about risk management. It's not about picking winners. It's about not putting all your eggs in one basket. And that's what really should happen in even the equity crowdfunding side, is that really should be pushing diversification for retail, because that's the most important risk mitigation tool, is spread your bets. So now, property, industrial, commercial, resi, rural. We bought our first cattle farm in Western District of Victoria from the people that were in Kidman. We're going to do a lot more. We're about to create a strategy campaign for young farmers. So these are Australians who say, well, bugger, selling Australia off to, whoever, or big institutions buying farms and appointing managers. Here is let's investors invest in farms and make a normal investment return, but make it available for the Gen X, Gen Y, millennial farmers. They need somewhere to rent to get their foot on the ladder. So we'll be doing that. Now, resi, another argument we've used is that if you look at the big industry funds, we paid Atchicus and consultant to do this, they back-tested having 20% asset allocation of resi. And guess what? Surprise, surprise, it reduced the volatility. Because what do you see, the ASX and everything else, the volatility is huge. So we say resi needs to be a part of an investment portfolio, and this shows you the volatility is better. So in other words, the experience of investors is better, but the return is also marginally better over 20 years. We're about to launch a couple of resi campaigns backed by Moody's Analytics, where they've selected the top cluster of suburbs in their mind that in over 10 years they're going to outperform. So we're going to create the Aussie Resi Fund, Melbourne, Sydney, Brisbane, Adelaide, Perth, Canberra, Darwin, and then the Gen X, Gen Y who are living in Canberra or Adelaide or Sydney and want to save their deposit, they can save in the market that they wish to eventually buy in. Then obviously I talk about the friends and family campaigns as well. Basically what I said, rent to own, they can start buying a bit and eventually own the apartment if they so wish. The other thing we're doing is residential crowdfunding at the moment is a bit of a hard ask in some cases, because what are the headlines? Disaster, bubble, crash, Armageddon, and it's a brave advisor who goes to their clients, let it load up on resi. Sure, you still, because the talk of disaster has been around for 15 years. I know people who sold their property in Brighton and 7 years ago waiting for the price to go down, and they're still waiting. We've also been approached, and there's a couple of thematics that we like. We get approached all the time, and we have to normally hit developers and other people with property with a big stick. But these I really like because they have underlying thematics. First is, are we going to need less or more affordable housing for retirees going forward? More. So therefore, we're supporting a couple of those. Are we going to need less or more renewable energy, which is base load, which is distributed around Australia? More. We're supporting that. That's active right now. The other things, a lot of these country towns have suffered from an exodus of infrastructure. And so we've got a couple of groups that are creating infrastructure in regional towns, and I will talk about the first one. Now this is for both advisors and individuals, because people do want to make a difference, but still make a return. And so that's what we're interested in. Now the other thing is that this struggle for us, we had a struggle trying to find a bank willing to lend to us. So with a bug of this, we'll crowdfund our own debt. And that's what we're about to do. So we've got advisors who want to create an investment option for their say 30, 40, 50-year-olds who need growth, in which case we'll have 60% equity and then 40% debt. Well, then they also have other clients who are retired, and frankly, when they did their financial planning, were predicated on a 5% income. You'd be lucky to get 2.5% in this market. So we're going to allow those advisors to crowdfund, but also we're going to direct consumers. They can come in and crowdfund first registered mortgage loans with an interest rate 4% over the overnight rate, which is very attractive. After our fee, at the moment, they'll get 5.06%. I challenge you to find a bond with such a good return for such a low risk. And the other final thing, now we talked about ASIC. We've just had our ASIC turnaround. It's been 3 months just to change the trustee, which is the solution for the debt. This one here, equity release, we needed a further, what they call ASIC release, exemptions from the Corporations Act, 4.5 years. So we lodged 4.5 years ago, and 3 weeks ago we got the in principle, and now we're just waiting to get the actual instrument. This one here, just quickly, it's the opposite side of normal crowdfunding. Crowdfunding is normally 10 of us get together, we syndicate to buy a whole property. Here is I own a whole property and I want to sell a third. Okay, who do I sell to? I don't sell to one individual. We will let people crowdfund that debt, not that equity, because they're actually buying a bit of Grandma's, Jane's house. Clearly, we're targeting the baby boomers for whom super came too late, but they all own a multi-million-dollar house, but they've got no cash. And so how can they do it? They can start selling a bit of their house and still live there. That's another form of downsizing. And this one's the big one. We've been with the ATO for 3 years at the moment, quality time. We've taken them to federal court in May. Had several case management hearings. Our final hearing date's on the 27th, 28th of November. We're seeking a ruling from the federal court that DomaCom is a widely held trust. DomaCom is not a related trust. DomaCom is not an in-house asset, and DomaCom doesn't breach the sole purpose test. What does this mean? If we are successful, people will be able to crowdfund the acquisition of an apartment using their super and non-super assets, and their children's super and non-super assets, and their child can apply to be the tenant of it. Okay? So I know some people think that's going to be really terrible for property. Actually, it's not. Because you use more capital, less equity, it's not a speculative investment, and the fact that I own, I'll do this for my son. The fact that he owns, 10% through his super, still feels like a bit of ownership. And next year, what does his super do? His super fund gets another 10 grand contribution. Well, his super fund buys off my super fund using our secondary market, arm's length at valuation. Now, at no point has my super fund lent any money. Has no point has Alex or my son's super fund lost any money. So we believe we are the solution, but clearly the ATO believes otherwise, and it's going to be a full-on thing. So I think we're about it. Thank you.